If you were to lose everything tomorrow, your savings, your assets, your safety net, and you had to start again in 2026, would you know how to actually build wealth? Or would you just know how to work? Let's look at a realistic scenario for a young professional today. We'll call him Alex. Alex is 26, living in a city like Atlanta or maybe Manchester. He earns a decent starting salary of $60,000. After the 2026 tax brackets and standard deductions, his take-home pay is roughly $3,800 a month. On paper, Alex is a success. He has the degree and the job. But the math of 2026 is unforgiving. His modest one-bedroom apartment is $1,700. His car payment, which he felt was necessary for a reliable commute, is $550. Insurance is $150. His student loans, which have been accruing interest for years, take another $350. By the time he pays for groceries, his phone bill, and a basic internet connection, Alex has less than $500 left at the end of the month. Alex feels like he is broke, but the reality is more nuanced. He isn't broke because he doesn't earn enough. He is broke because he is trapped in a system designed to hijack his margin before he can ever use it. He looks at the stock market or real estate and thinks, "I don't have enough to start." He believes that investing requires a large lump sum, a mountain of gold he hasn't climbed yet. This is the fundamental system flaw. We have been conditioned to believe that investing is the final step of a financial journey. In reality, in 2026, investing must be the first step, or the journey never begins. The mistake Alex is making is waiting for leftover money. But in a consumer-driven society, there is no such thing as leftover money. If you don't give your dollars a job, the economy will find a job for them, usually paying someone else's interest. Let's look at the simple math of the starting small fallacy. Alex thinks his $100 or $200 a month is insignificant. He thinks, what's the point? It won't buy a house or a Porsche. But he is looking at the money, not the time. If Alex finds a way to invest just $200 a month into a standard total market index fund, and we assume a conservative 7% annual return in 30 years, that insignificant amount grows to over $240,000. That is the power of a single decision. But if he waits 10 years until he earns more to start investing $500 a month, he ends up with less money despite contributing more of his own capital. He cannot buy back the decade he spent waiting to be ready. The psychological reason Alex and most of us make this mistake is due to present bias. Our brains are wired to value a reward today over a much larger reward 30 years from now. In 2026, this is amplified by the digital world. Every time Alex opens his phone, he is hit with images of peers who seem to be living at the finish line. He sees the lifestyle before he sees the balance sheet. To keep up with an invisible standard, Alex spends his margin on things that depreciate. He buys the $800 phone on a payment plan. He finances the furniture for his apartment. He is trading his future autonomy for a present-day illusion of status. This behavior is a survival mechanism gone wrong. Historically, being part of the successful group meant safety. Today, trying to look successful is the fastest way to stay financially vulnerable. We are using 21st century tools to satisfy prehistoric insecurities. The intelligent person in 2026 recognizes that the system is essentially a giant machine designed to separate you from your capital. Between subscription models, financed lifestyles, and targeted advertising, the default state of a modern professional is to have a net worth of zero. To move from NORT to a position of strength, you have to stop thinking about what you can afford per month and start thinking about what you are willing to own. Financially intelligent people behave differently. They don't look for the best stock or the hottest crypto trend. They look for the highest possible gap between their income and their expenses. They treat their savings rate as a higher priority than their social standing. They realize that in 2026, the greatest luxury isn't a luxury car. It's the ability to not care what your neighbors think of your car. Wealth at the 0 point isn't about the math of the market. It's about the math of the self. It's about auditing every dollar that leaves your hands and asking, Is this buying me freedom, or is it buying me a temporary feeling? If you can master the discipline of the first $1,000, you have already done the hardest part of investing. The market does the rest of the work. But most people never get to the first $1,000 because they are too busy trying to look like they already have $100,000. Starting from $0 in 2026 requires a shift from a consumer mindset to an owner mindset. Most people in the US and Europe are trained to be the best consumers in the world. We are excellent at identifying the best value on a lease or the best rewards points on a credit card. But very few are trained to be owners. An owner doesn't look for the best deal on a product. They look for a share of the company that makes the product. The strategy for 2026 is intentionally boring. It lacks the adrenaline of day trading or the complexity of high-stakes real estate. It's based on the rule of zero complexity. The more complex your investment strategy, the more likely you are to abandon it when the market gets volatile. First, we have to address the emergency buffer. In the professional world, we often hear about 6 months of expenses. For someone starting at zero, that sounds like an impossible mountain, but the reality is that your first $2,000 is the most important investment you will ever make. This isn't money for the stock market, it's insurance against your own life. It ensures that when your car needs a new alternator or your laptop dies, you don't reach for a credit card with 24% interest. Every time you pay interest on consumer debt, you are effectively reverse investing. You are paying for someone else's retirement. Once that buffer is set, we move to the engine of compounding. In 2026, the most effective tool for a middle-income earner is the low-cost total market index fund. Whether you are using a 401k in the States or an IC in the UK, the logic is the same. You are buying a tiny piece of the entire economy. You are betting that over the next 20 years, the collective ingenuity of thousands of companies will be greater than it is today. Let's look at the math of the lifestyle audit. Imagine Alex, our professional from Part 1, decides to stop renting his status. He cancels 3 unused subscriptions, switches to a more affordable phone plan, and eats out 2 fewer times a month. He finds an extra $300.